Okay. So we are all gathered here today to dive into the income statement. So thank goodness we're doing this on a Tuesday, right? Because if it were a Friday, no one would be here probably. But I hope that this will be informative for you all. And so there are essentially three areas that I'm going to talk about around the income statement. So one of them is about QuickBooks specifically, because I use QuickBooks a lot. A lot of my clients use QuickBooks. So I do want to talk about some of the quirks, if you will, of how QuickBooks is set up. And that's going to be our kicking off point for things you need to think about in terms of how you would set up an income statement and all of that. Then we're going to talk through the structure of the P&L or the income statement, and you'll hear these words interchangeably, but they mean the same thing. Income statement, P&L, statement of operations, they all mean the same thing. I wish accounting had a standard nomenclature, but they don't. So that's the problem a lot of times with learning this stuff. And then we are going to really talk about and dive into the different things that you can do within QuickBooks to make your income statement really work for you and provide you the information that matters to your business. So before we get into the details of all of that, I want to hear from all of you. Kind of, do you even look at your income statements? And it's okay if you don't. Hopefully, after tonight, you'll feel a lot more comfortable in looking at it and knowing what it tells you. But, any burning questions you have right now before we dive in? And hi, John, welcome.
Hey, John. So I will go first. I do not look at my income statements. I'm married to a former CPA who works as a CFO for companies, okay. And I am 100% reliant on her. God bless her. And so maybe I will be able to impress her after this.
Okay, good.
Hi, it's a high bar.
All right.
So I'd like to go second. So Mark, to your point, so my husband has a business and, he has an accountant and a CPA and all of that. But I don't ever look at the books. So I think that this is an opportunity to say, hey, let me look into those books.
What are you doing? Yeah. Okay. Okay, John is going to be talking to us through chat. All right. Not a problem. So good. Anyone else?
Yeah, I don't necessarily do an income statement very frequently, but I track things pretty on a per transaction or a per project basis really closely.
Yeah.
Especially on the renovations, because there's a lot of expenses that go with projects like that.
Okay. All right. So also
I have people for that, so
Yeah, just like Mark, right? Okay. So before we get too much further too, introduce yourselves to all of us, as well as so John says he watches his P&L and balance sheet at least monthly. Yay, very nice. So just give us a little background on kind of what you do, what your business is, that sort of thing. So Mark, do you want to start first?
Yep. Okay, so my name is Mark Walters. I am an attorney with Reed Pruitt Walters Larson. We are a small mid-sized business outside general counsel firm. So got a bunch of small mid-sized business clients, and we also do some commercial litigation.
Okay, thank you. Gloria?
I'm muting now.
Okay.
So I am an adjunct at Central Washington University. So I'm working there. I'm also a student in a doctorate program at City University of Seattle. And so my specialty with teaching is around finance and accounting, and my dissertation is also on the same topic.
Thank you. How about Ben?
So my name is Ben Longenbaker. I'm a residential real estate agent with North Pacific Properties. I help clients buy and sell residential properties. I'm also a real estate investor. So I buy and fix and flip or rent homes, condos, things like that.
All right, wonderful. Thank you. Thank you. And John, you can put your description, your short description. Yeah, there we go in the chat. Okay, so he's with Time Equipment Company. Very good. Oh yeah, HDTV. Very nice. Cool. And Alexis.
Hi, I'm the founder and owner of Voices That Get Heard LLC Voice Studio. I have a long history as a performing artist in dance and music. And now I pretty much teach exclusively, although I've done, audiobook narration and other voice related things. And I'm like a lot of artists who's kind of like, I don't do that part, and I'm not really a flaky person, but it's not really focused on in the arts world. And so I'm also part of a network cooperative of independent studio owners that are really trying to get kick-ass at business. And so my fabulous business person here is, helped me a lot understanding the value of becoming an LLC S Corp business and moving myself out of the little neighborhood voice studio into an actual viable business. And I just love it. So I just want to learn more and more.
Cool. Very good. All right. So let's jump into QuickBooks a little bit. So if you're using QuickBooks already or have used it or whatever, QuickBooks comes pre-populated with a chart of accounts. And for the most part, when I've seen people go into QuickBooks, you just sort of adopt that thing in and off you go, without giving a lot of thought to what the general ledger accounts are and things like that. So for instance, I'm going to show you the sample company that's in QuickBooks, and we will talk from there. So let me share my screen. Okay. So can everyone see this? Can you see QuickBooks with Craig's design and landscaping service here?
Yeah. Okay.
All right. Very good. All right. So when we look at the chart of accounts, for instance, right now, this is what it looks like. So essentially, it's got the name of an account, the type that it is, etc. Okay. But for instance, when this first comes to you, you might have a revenue account and it just says revenue, or it might say sales. Okay. And that's just kind of a generic term that QuickBooks uses to give you a revenue or a sales account. Okay. It will have things like telephone expense. It'll have some of the common things that you would use in a chart of accounts to actually create an income statement. However, you can do more with it. All right. So for instance, if you have a revenue, let's see, let me find one. Okay. So, okay, like this other income, right? Or, in this case, this is a landscaping company, so they have, some labor that they will charge, job materials, landscaping services they will charge and get income for. And so this is actually broken out fairly well in terms of actually giving you more detailed information about your income. So in other words, if QuickBooks just gives you a revenue account or a sales account, that's not going to give you a lot of information about your business, other than giving you a grand total of revenue, a grand total of income. Okay. And so for instance, if you are wanting to actually see a breakdown of different products that you sell or different services that you sell, you would probably want to break that out into different accounts so that you can actually see that. So for instance, I know that Alex has voice students and she has speakers that come into her business. Predominantly, she has voice students, people that are coming to her to learn how to sing. But at the same time, she has a few clients that come for learning how to speak in public, because it's another thing that she does as a specialty. All right. So Alex, would it be important for you to see revenue that's broken down by those types of clients? Would that be useful
Yes,
to you?
yes, because of the fact that there are very different kinds of clients, and voice students know they're in the long haul, possibly years of weekly lessons to develop an instrument, a voice as an instrument. Speakers tend to want short-term solutions. They may turn into someone who understands the value and efficacy of training their voice, but in the beginning, they want a package. They want, I want to learn this. I want to be in 3 to 5 sessions. Give me one price. And that is a completely foreign situation for me.
Mm-hmm. Mm-hmm. Okay. So for Ben, do you have a situation where you might have different products and services? So you do look at projects, right? You look at it by project, you look at
Yeah,
revenue
so
and look at,
sort of per property.
okay. Okay.
But there will be
And
different projects within that. There may
Right.
be plumbing, electrical, different tradesmen.
Okay. Okay. Because you're flipping houses, right? Is that correct?
Mostly, yeah.
Okay. All right. Got it. Okay. How about you, Mark?
Yeah, I have like my model is I have a short-term cash flow model, and that is transactional projects like working on a contract for a client.
Mm-hmm.
And then there's litigation, which is a longer term project.
Okay. All right. All right. Good.
And in the contracts, there's hundreds of different kinds. So
Okay. All right. Good. Yeah. And so each of these can be, there's lots of different ways within an income statement that you can break out this information. And so one way you can do it is through your chart of accounts by having different kinds of income or revenue accounts, so that when you're billing somebody, you can use certain products, certain services that you've built into QuickBooks that say, okay, if I'm selling a product, I want that to go to product income. And so you can have an item set up or a general ledger account that's associated with it that goes directly there when you bill a client for that. A service, same thing. So let's say you're doing something else that's not product oriented, but you might be consulting with somebody about what you do, and you charge for that. And so you can have another item that has that and a different chart of account or a different revenue account associated with it. So as you're billing, as you're invoicing people, you can set it up to where I want this to go to product income, but I want that to go to service income. Okay. So John has in the, okay, so he has clocks, time card, software as a service billings, installation, support, annual maintenance. Great. Great. Yeah. So all these different categories, you can break them out so that you can see over time that this business, this part of my business is growing, or that part of my business is starting to, taper off or something like that. Is this job costing? It could be. Yes, it could be. It doesn't have to be though. But what you bring up is a good point, Mark. It's a good question in terms of, all right, so if I have my income broken down by different types of income, then I may also want to have the associated costs broken out into cost of goods sold categories. Okay. So let me show you what I'm talking about there. We'll go back to our lovely QuickBooks company here. And I'm going to go to the income statement for this sample company here. So here on this profit and loss, so one of the things that I see here is that here's the income or the revenue category. And so underneath that, they've got design income, some discounts given, landscaping services, and various different things underneath that. Labor, for labor installation, time they spend on that project. Pest control services, sales of product income, and services. So all of these different accounts are grouped together so that the company can see all of the different types of income that they bring in. Now, what I would typically see, so here we have a cost of goods sold. Okay, so here the cost of goods sold is not broken out by anything. It's just this bucket called cost of goods sold. But we could have, for instance, a cost of goods sold that has to do with the actual cost of the job materials that went into these fountains and garden lighting, right? So for the revenue of $1,500, what did it cost to install those fountains and garden lighting, right? So the actual materials that they used. So you could have down here a cost of goods sold that is directly associated with the fountain and garden lighting, or plants and soil, or sprinklers and drip systems, right? So that for the corresponding income account, you could have a corresponding cost of goods sold. They don't break it out here like that, but if you want it to look that way, you can make it look that way, okay? And so part of the design of an income statement is to make it work for you, so that when you see that income statement, you can see, well, I'm earning money here, I'm having to spend some money here to earn that revenue. And so the revenue and cost of goods sold sections are really important. And what I often see people forget about is that cost of goods sold section. I have seen a lot of income statements that have the revenue and then just a whole bunch of expenses without it actually breaking apart stuff that's really related to that revenue. So in other words, when we create revenue, usually there's some direct costs associated with that. So like in that landscaping company, if we're going to put in a deck, we're going to need, some lumber or composite materials. We're going to need some, probably some hammers and some nails and some various other things that we're going to have to use in order to build it. And so being able to see the revenue and the cost of those materials so that we can match those up and see that we're making a decent return on that, or a good gross profit, is important. All right. So I want to stop there just for any questions you have right now, because I'm throwing a lot of information out.
So I have one question on that sample P&L. I mean, his cost of goods sold seem very, very low.
Yeah.
Right. So obviously he's not taking any person's manual labor into account.
Right. Yeah. And this is something that I've seen with some clients where all of the salary and the payroll is all down in the general expenses. Okay. So if we look back at that again, let's see here where it's probably, all right. So let's look here. Okay, so see these job materials here? So there's the decks and patios, plants and soil, sprinklers and drip systems. All of that, in my opinion, should be up in the cost of goods sold section. Okay. Because to me, those are direct costs of actually earning that revenue from above. And then I'm trying to see, I don't even see any labor being paid for, which I think would be suspicious in this sample company of like, why in the world there isn't any? Because obviously for a company that does landscaping and things like that, you will have labor associated with that. So yeah, but great point, because there will be direct labor, the labor that actually builds these products for clients. And then there's salary or labor or, those kinds of payroll costs that are associated with the owners, with, staff, with, those kinds of individuals. And we want to make sure that those things are in the right place. Okay. So essentially, the major sections of an income statement are the revenue, the cost of goods sold, any of the direct costs that are associated with generating that revenue, your gross profit line, your general expenses, and your net profit at the bottom. Okay. And so I've had people ask me, well, how do I know what it costs me to run my business? That's in the operating expenses. So if we look back at this, so think of it this way. You have your revenue, your income, and the cost of goods sold are any costs that are directly associated with generating that revenue. Okay. So if we don't have any sales, we don't have any cost of goods sold. They are very tightly bound to each other. They should be anyway. And so it's after the gross profit, these expenses down here, except for this, I would say this goes in cost of goods sold. But like advertising, the company automobile, legal and professional fees, accounting fees, lawyer fees, all that kind of stuff down there, utilities, all of that. That's your operating expenses. That's what it costs you to run your business. So if you have no sales whatsoever, you would still pay these operating expenses. Okay. So people have had this happen during the time of COVID. They have suddenly figured out, oh, operating expenses. Yeah, that's what it takes to run my business. And so I've had a few clients that have not had a lot of sales since COVID. And they're still having to pay those operating expenses. As long as they're trying to stay in business, they're going to have a certain amount of expenses they have to pay, even though they don't have any revenue coming in. So it's made people very much aware of, yeah, those are the expenses that it takes me to run my business. And so, some of my clients have really had to cut back on those operating expenses right now because, there's not a lot of revenue coming in. That was a great question. So anyone else?
So I have another question, but
Yeah.
I don't, John has a question.
Oh, all right.
In the chat first.
Okay, what is the best way to get labor into cost of goods sold? Okay, I have mine and my expenses. So are you meaning, John, that you have, when should labor be put in cost of goods sold? Okay, so that's a really good question. So for instance, let's see, let's take a good example here. So for example, if we were actually keeping the books for this landscaping company, there would be people who would be going out doing these jobs. Okay. So there would be a carpenter type person or something like that who's going to help build that deck. Okay. And so, for instance, through, some sort of timekeeping mechanism, like, the company that John has, that person would go out and say, I'm working on such and such a job. And because the job is set up, and QuickBooks can actually do that, and timekeeping software can do that, where it's like, okay, for this job is associated with this client. And so when I'm working on this job, the timekeeping system and all of those mechanisms will make sure that the labor paid to that individual, the payroll expenses that are paid to that person to go build a deck, will go to the cost of goods sold because it's associated with that job. Okay. And so even within QuickBooks, you can set up jobs by client and have people, when they're doing their timekeeping, say, all of my time last week was spent on X job. Okay. So if you have support technicians that are there all day, regardless of how many calls come in, that is expenses. Okay. So yes, if you can trace those wages to an actual job, I would make that cost of goods sold for sure. Yeah. That's a great way to think about it. And so it's really about traceability. It's about being able to pinpoint that the work that this person is doing is for this client. So for instance, I have some people work with me, contractors, and I have them doing documentation for clients and things like that on the back end. My clients never talk to them really. It's just, I need help making sure that we have a good set of documentation for how their books are kept and how transactions are flowing through and things like that. So that if anything ever happened to me, another accountant can pick it up and take it from there. So when I have them doing their timekeeping, I ask them to make sure that they put in, I spent an hour on X client. I spent 2 hours on this client. So then when I go to pay them, I take those records and I can then tell QuickBooks, okay, this hour was for X client. These 2 hours were for Z client. Okay. And so I then I can match up that particular client. I can look at a client in QuickBooks and see all that I've billed them, as well as if I've paid any of contractors, if I have direct expenses that are associated with those clients, I can put all of that together so I can see the profitability of that client by themselves. And that can be really, really important to look at that and to at least make sure that you're being profitable on every client. And so it sounds like Ben is doing something like that already with his locations, his properties. Is that kind of what you're doing?
Yeah, I'm tracking each project's expenses and then breaking them down by specific trades, because I have individual budgets for each item at the start.
Mm-hmm.
And that's both what I pay contractors, and also a lot of times I'm the one that's buying the materials. So
Okay.
tracking to make sure that all that together is fitting within the budget.
Okay. All right, good. Yeah. And so, for instance, I want to show you, this was something that I showed a client recently, in being able to show her kind of what was happening for her business. So when I first looked at her income statement, she does consulting, and so she didn't have any cost of goods sold at all. And I said, well, but you have consultants that are out at these locations, working with your clients. So their time should be shown against that client revenue, so that you can make sure that everyone is profitable, right? And so we went through an exercise where we started pulling apart the payroll. So any consultant that was working with a client, we pulled all of those hours out. We're still in mid process of really pulling all of the direct costs associated with those consultants out. But these numbers are not exact. I kind of played around with them for purposes of today, but it's a real example, but not real data. So let me show you what this looks like. So here is, I created a profit and loss that is just basically down to that gross profit line. So I only wanted to look at the revenue accounts and the cost of goods sold accounts, okay? Down to this gross profit. So this is the gross profit line here, okay? So what do we see? Just looking at these, now this is a gross profit percentage. I didn't mark it as such, but what do you see in this data?
Some are more profitable than others.
Mm-hmm.
Pretty good margin though.
It is a good margin. Yeah, it's a decent margin right now.
Oh, it's missing stuff, isn't it?
Yeah, yeah. Like, here we have some income and we have no consulting time working on it, right? So we got 100% revenue there. And what about this one? Okay. All right. And so this is why we want to look at this, because if we don't look at it in enough granular detail for your type of business, whatever that is, and so some people want this, like Ben sounds like he is much more really diving into details than some companies would, right? But even in this company, breaking this out so that we could see it client by client has shown some very interesting things. It's like, okay, so why is that? And what is that? And, why are some of these looking a little odd, and they may be actually accurate. But it also gives us an idea. We could also see that perhaps some consultants are a little bit more efficient than others. That's possible, depending on the type of work that they're doing for the client, and that could be another question that starts to pop up eventually is, maybe best practices can come out of it, as a way of being able to highlight that some people are maybe more efficient than others. I don't know where this will lead, but it's now a very interesting view of this data that this business did not have before. Okay. So what do you think? Especially when, oh, I see there's a good margin, but missing overhead. Yeah, possibly. And I know we have not yet pulled out all of the direct costs of goods sold for those clients. All we've done at this point is pulled out salary. I know that there are, other benefits that go along with those individuals that we need to look at how we're going to break those out. So sometimes this takes a little bit of, figuring out exactly how you're going to do it. But anything can be done. It's just a matter of, just how much of a headache you want to go through. A lot of times this is pretty simple, especially since like being able to do that. I just asked for a per consultant payroll report out of the payroll system that they use, which is separate from QuickBooks. And they had a really nice detailed level consultant time that's actually directly associated with a client. So it was pretty easy to pull it out and then leave all the rest of the payroll in the general expenses, in the operating expenses. Okay. So let me show you their, kind of a mock-up of their P&L just to that gross profit line. Okay. So just for being able to compare and contrast here. So for example, this is what the P&L looks like down to that gross profit line. All right. So yes, this is a healthy gross margin for a company. It's very, very healthy. In fact, so once we get some of the other costs associated with consultant salaries in here, I don't know, this might go up to, I don't know, maybe 20,000. Let's just say it's going to go up to 20,000. So a 50% gross margin, it's pretty decent, right? But looking at that only gives us one dimension of information about the company. And so once we started breaking this out and looking at it by client, she was looking at that going, I do want to follow up on a couple of things, because she had not seen it before. She had not been able to drill down into that level of detail of being able to look at the different clients and see, if something looked out of the ordinary. But, overall, this is a great profit margin. And so if anybody can get to 50% is really good, in my opinion, especially for gross margin. But, some industries, some companies are better than others than, like if we were looking at a restaurant here, this gross margin would not be anywhere near this. And that's why a lot of times when rough economic times like COVID come along, you'll see restaurants going out of business because they just don't have the kind of margins to kind of help them, save for a rainy day kind of thing. In fact, I have one client where there's two distinct parts of her business. And so one of the challenges that she had is that her entire P&L had both companies sort of commingled together. So being able to pull apart, that revenue and cost of goods sold associated with this business versus that business is crucially important. So being able to have two different income accounts, or using some of the other tools like projects within QuickBooks, or using classification codes and some of the other tools that QuickBooks has, you can then break out, at least to the gross profit. You can break out, here's company one and here's company two, and look at the revenue and cost of goods sold for both companies, which has been incredibly important for her to be able to understand how best to leverage her company. Because, for instance, one company is volume driven. It needs a lot of volume because it has low margins. Okay. So her gross margins on one side of the business is at best going to be about 18 to 20%. So she wants as much volume going through that side of the business as she can handle. Then on the other side, it's high margin, but very, very few events happen. So she's a travel company on one side and an events manager on the other side. So the events management she makes a lot of money at that, but it's labor intensive. It's a huge amount of work. She can only handle maybe one or two of those a year. You can't send volume through that side of the business at all. Okay. So understanding these nuances is how, when you're breaking apart, some of these income lines and cost of goods sold, you start to get a feel for, okay, this is how this works. I can lever this one in a different way than I can lever that one over there. All right. So any questions right now?
So Julie, Mike, going back to that fictitious QuickBooks company. So would it be fair to say that at the end of the day, most, like with small businesses, I mean, you're really looking to get that net profit to be as low as possible in certain circumstances because of taxes, right? So could it be a deliberate act of not putting the salaries up in cost of goods sold, so to keep that net profit low, right? Because that's what I'm going to be assessed on when it comes time to pay taxes. And I mean, it's a tactic, it's a practice sometimes where, things are bottom heavy intentionally, right? So my question is, when these taxes get filed, does the IRS ever go through that to say, come on, you can't have all of this stuff going on over here and $405 in expenses? I mean, would that only occur during an audit?
Yeah. So John says only if you're a corporation. Yeah, we hear stories about Amazon doing things like this where they really maximize or minimize their taxes that they pay, and things like that. But you also have to remember too that the IRS is just one taxing agency. And so some taxes are based on your gross profits. Like in the state of Washington, the Department of Revenue is based on gross profits, not net, And so one strategy for the IRS might not work for other taxes that you have to pay. And so that's one of the reasons why you have a good CPA and a good tax person that can help you with strategies around that. Because essentially, yeah, when you have the like a lot of the clients that I work with are LLCs, so it's passed through income. And so it gets added to your income and all that kind of thing. And if you haven't been, at least contributing to taxes with the IRS, you can have a big tax bill at the end, which you can actually pay penalties for that if you have underpaid your taxes to the IRS. So yeah, there's all kinds of considerations around that. But as far as the IRS looking at somebody and saying, well, it seems like you're just trying not to pay taxes. The only time that I've really heard that they are concerned about that is when you're showing net loss after net loss after net loss after net loss after net loss for years, and then somebody's probably going to flag you for an audit. That sort of thing. Okay. All right.
Thank you.
Does that help?
Yes, thank you.
Okay. All right. Thank you, John. All right. John has to go. All right. So anything else right at the moment? Okay. So essentially, there are several ways within QuickBooks that you can make sure that these things happen. One is through looking at your account structure. You can make your chart of accounts anything that you want. You just want to make sure that you don't mess around with, because one of the great things about QuickBooks is that it actually puts all of your financial information into the appropriate way that it would be reported to the IRS. So you want to be careful in setting up new accounts and making sure that you're putting them in the right categories and all that kind of stuff. And that's where somebody like me can help you with that to make sure that you're not making a mistake there. So one, you can use the chart of accounts and you can make it anything you want. You can have all kinds of different, there are some limitations to how many GL accounts you can have in QuickBooks, but that's another thing entirely. But QuickBooks has other ways to do it. It has the project tracking, right? So like in Ben's case, you could have a client, they could have multiple projects, or you can have one of the properties that has multiple things that you're doing to it or improvements that you're doing to it. And you want to track all those different projects against that location. That's a great way to do it. Also, QuickBooks has classification codes and they have tags now. And these tags, you can do reporting on the tags, So if you don't want to build a whole bunch of new chart of accounts, you can have tags or these classification codes and just attach them to these transactions, and then you can report on that. So it's kind of a separate way of being able to report things, because when you go in and create a report, you can look at it by tags. You can group things by classification code, and there's project reporting in there. So it just depends on kind of what you want to see and how you want to track it as to which way would be the best way to go. But there's lots of flexibility, which in some cases can be really great, or it sometimes is confusing as to which one you want to do. But I hope that helps to kind of understand that, the income statement at its very high level gives you a certain amount of information. But the more you can play around with how you want to see information at a more granular detail that is specific to your business can really help you in understanding sort of growth patterns, or, maybe, students are really liking certain things that you're doing, Alex, around, maybe your voice coaching is growing way more than the speaking piece. Like for me personally, I have client income. I have some other sources of income. So you can even break out customers by different classifications too. So for instance, I have books on Amazon, and I have books in some other places that I've done with different publishers. So I have like a passive income line item on mine that has to do with books and other things that I have for sale out there, as well as the direct client. So once I write a book, that thing is off kind of doing its own thing, other than some promotion I may do occasionally and things like that. So breaking out these two sort of income streams to me is important to see, how my client base is doing versus, how my products are doing, that type of thing. Okay. So just some things to think about. If you haven't done it before, to look at your income statement in a little bit more granular way, even if it's just adding a couple of new revenue accounts and cost of goods sold accounts, or even tracking cost of goods sold for the first time, it could tell you a lot about your business that you may not have known before. Okay. So any more questions at all? Any other comments?
Just how to make more and keep more of it.
Oh yeah, there is that.
Yeah, I think that's really interesting. Sort of some really good info, because especially when you have really detailed items for a business, it's important to keep track of what is kind of losing you money, or where where you're more efficient, and can focus on that, like you said, with some of your clients, where you're kind of telling them, okay, maybe we should shift our focus to this part of the business, and kind of not so much on some other parts. And I think
exactly, because you could have some products that you're losing money on, or services, and it's like, okay, sometimes you make strategic decisions about that,
Sure.
You might want a loss leader for some reason. It gets somebody in the door sometimes, right?
Right.
There are business models out there where that's part of the strategy. Okay. But at least it's up to you then, and you're more in control and making the choice as to whether or not that's what you want to do. And it's not just something that's lurking on your income statement that you didn't know was there.
Right. Yeah. More data is always better.
Mm-hmm. Yeah. Yeah. And, and I plan on doing some others where I look at, because within this, it's hard to do, QuickBooks doesn't do break even. It doesn't do some of those types of calculations. You still have to pull information out and go put it in Excel in order to do certain things. I don't know of any software that does everything that you might want to look at financially. But we can always talk about those kinds of topics, some other time. But that's the reason why we want to do it, is that eventually we may pull it out, throw it into Excel, and do some other calculations on it. And the more that we can think of our financial information as financial data, like a data scientist, like a data analytics person, there's lots of things you can figure out about your business that you may not have really thought about before.
Yeah, definitely.
Cool. Anything else? Okay. Well, I hope this has been helpful. I plan on doing some more of these, and and I hope to see you again on another webinar. Thank you, everybody.
Awesome. Thank you.
Thanks for doing this, Julie.
All right, you're welcome.
Nice meeting everyone.
Yeah, you too.
Great meeting you as well.